In the context of the Indian stock market, PE stands for price to earnings ratio, while CE is not a commonly used term. It is possible that you may be referring to call option and put option, which are commonly used in derivatives trading. The price to earnings (PE) ratio is a valuation metric used to evaluate a company's stock price in relation to its earnings per share (EPS). The formula for calculating the PE ratio is simply the market price per share divided by the earnings per share (EPS) of the company. Generally speaking, a high PE ratio indicates that the market has high expectations for the company's future growth prospects, while a low PE ratio may indicate that the company is undervalued by the market. Investors can use the PE ratio as a tool to help identify undervalued or overvalued stocks. For example, if the PE ratio of a particular stock is lower than the average PE ratio of its peers or the market, it may be considered undervalued and a good buy opportunity. Conversely, if the PE ratio is much higher than its peers or the market, it may be considered overvalued and investors may want to avoid buying it at that point. Regarding the derivative trading, call option and put option are two types of financial contracts that give the holder the right but not the obligation to buy or sell a security at a specified price, called the strike price, within a specified time period, called the expiration date. By buying or selling these options, investors can earn profit by correctly predicting the future direction of the stock price movement. It is important to note that trading in derivatives involves high risk, and investors should have a good understanding of the market and the associated risks before participating in such trades. It is always recommended to do thorough research and seek professional advice before making any investment decisions.